Hello and welcome to this Manufacturing Management webinar. My name is Paul Fanning and I'm editor of Manufacturing Management. Today's webinar is entitled Mastering Energy Markets, Efficient Procurement Strategies for the Manufacturing Industry. And here to present it today are Jordan Rassus, Head of New Business Sales at Inenco, and Alex Wilson, Consultant for Inenco. Before I hand over to them, however, I should just say if you have any questions during the presentation, please type them into the box on the right-hand side of your screen and we'll endeavour to answer them at the end. And with that, it just remains for me to hand over to Jordan and Alex. Thank you.
Well, cheers. Thanks, Paul. I think we'll just do some very, very quick introductions. My name's Alex Wilson, consultant, been with Inenco and in the energy industry for 6 years, primarily working with manufacturers.
Yeah, I'm Jordan Rassus, Head of New Business. As Paul said, I've been in the energy industry now for 13 years, and I've worked with Inenco for 10 of those years. And my role has always been working with non-client prospects, putting together new energy procurement strategies. And largely a lot of that role has been working with the manufacturing sector predominantly too.
Cheers, Jordan. So yeah, in terms of an agenda, keep this very brief for today, but we're going to do a very short introduction for Inenco. I know we've done quite a lot of these webinars before. Jordan's going to take an analysis of the current energy market, what's going on, some future trends, and then we're going to actually give you some actual practical guides for you to take away on what good energy procurement looks like, followed by a Q&A session. So just very briefly, in terms of who Inenco are, for those of you that have just joined us or not joined a webinar before, we currently manage £5.4 billion worth of energy under management. We pioneered wholesale procurement. Our energy trading team have a massive amount of experience, and in terms of our history, we've been running since sort of the late 60s. What that means is that from a volatility perspective, we've been through every major event that's happened in the energy market, sort of Middle Eastern wars, miners' strike, market dereg, the financial collapse, the beast from the east, you name it, we've been through it. So Jordan, over to yourself.
Yeah, thanks, Alex. And again, that was a very quick whistle-stop intro to Inenco, but I think the idea there, what we're trying to unpack or give away in that part is purely from a procurement perspective, as Alex touched on. A lot of the insights we're going to deliver now come from that trading department, which on its own has got 150 years worth of experience. And a lot of our current customers are quite fortunate to benefit from this kind of insight day in, day out. But we're also now going to have a look at what the markets have done in the last, let's say, 2 years or so, where we're at now. So, it's no secret that over the last 12 to 18 months, prices have been falling, and we're at what's now considered a low point if you look back at the last 3 years. And then we're going to try and release some insights on trends moving forward and what the future might look like. So without further ado, I'll move into the first sort of key takeaway here. And I think the first thing I wanted to unpack today was this new world that we're in. You'll hear me talk quite a bit in today's session about market cycles. So when you trade energy or gas, you're trading a genuine commodity that's, just like gold, just like oil. It's a live tradable commodity, and timing will often impact the price that's available or that commodity is available for. What this graph shows is the last 7 years of energy prices, 7 to 8 years of energy prices. And I guess the first key takeaway today is the world has substantially changed. If you look at the world pre-2021, the graph there, the lines for power and gas were both very, very stable. For periods they were falling. And what that meant was for a large period of time, I wouldn't say it was impossible to get energy wrong, but the impact of getting it right even was far, far less. What happened in 2021, however, was the dynamics of the market changed. A lot of the things that drive the prices that we see available in the market, they changed, and they actually changed forever. They didn't change, for a blip or for a moment in time. And what happened was in 2021, in that year alone, we went through a period where the UK's energy prices went from the lowest point they've ever been to the highest point they've ever been. And that was 3 months before the Russia-Ukraine conflict began. Now, I think the reason I wanted to show you this is because a lot of the issues that caused that initial spike, they absolutely still exist. Back then in 2021, what caused that initial market run was the fact that Southeast Asia, at a time when Europe had dropped off because of COVID, Southeast Asia was consuming more power and gas than ever before. They were buying more LNG than ever before. And Europe was allowing that to happen because we had a pipeline that was going to go live called Nord Stream 2 that ultimately was delayed, and then cancelled. Now, what that meant was at the end of 2021, because of the new LNG world, so to speak, we were already at a world where prices were at record highs. The Russia-Ukraine conflict not only then took us into another bullish run, so then you can see, the start of 22, a market that was already at record highs, then kicked on again. So why did that happen? I think one of the big things that the Russia-Ukraine conflict brought with it was legislation on the European side that, because of the previous reliance on Russian gas and the fact that we're no longer wanting to be reliant on Russian gas, we're going to have our gas storage facilities at a European level filled to a minimum level of occupancy each year. So what caused this price in 2022 was actually at a time when Europe had already suffered from record high energy prices. It then suffered from a genuine energy security threat, which meant that it needed to pass legislation stating that we would buy more LNG than ever before for delivery faster than ever before at prices that were higher than ever before. And that's what caused the market in August 22 to reach the levels that we saw. Prices for seasons were trading as high as £500 per megawatt. Day ahead almost touched £800 per megawatt, which was, really unseen levels. To be honest, anyone unfortunate enough to be in the market in mid to late 22, it almost broke the market. Suppliers were taking 12 to 16 weeks to release contracts. Businesses who'd previously had no issues with credit all of a sudden required huge credit deposits. And the market just went to this crazy point. Now, since then, the market has dropped off, which brings me on to the next part of the slide, which is, okay, so what's happened since August 2022 to cause the market to be where we're at now? Martin Lewis talking about prices coming down at domestic level. People are now getting a little bit more relaxed. But what's actually going on in the world? So I think the second key takeaway today is actually the market, the energy and gas markets, they're still incredibly reactive to bad news. But from an energy perspective, there just hasn't been any. And what there has been, we've been covered in relation to, and I'll unpack that shortly. So if you look at August 22, which was that peak that I talked about when prices were at these record highs, since then, when we got gas storage facilities full, everything that could have gone in the market's favor did. We had the mildest winter for 36 years, which meant that seasonal temperatures were a lot hotter than expected. We then had a voluntary lockdown in China at the start of 2023, last year, which 95% of the population adhered to, which meant that LNG that was previously scheduled to go there was now able to come to the UK. The one I don't like talking about is the cost of living crisis. There was a genuine choice made by a lot of households between heating and eating, and that made the domestic gas demand, certainly in Q1 last year, drop to one of its lowest points in recent years. And when we did see some bullish news in the market, i.e. the Australian LNG strikes, the Israel-Hamas conflict, they arrived at a point in which we'd gotten through the worst, the winter, and gas storage facilities were already full. Now, interestingly, as of last weekend, the UK, I think, opened up at 33% gas storage. So I think that situation now is starting to change somewhat. But the key point is, not only did things go in the market's favor, an awful lot last year, but when they started to turn, we were also really well covered at European level. Those facilities have now started exporting. They've now become depleted at various different levels. So in terms of looking at where that leaves us, I think the first thing I wanted to unpack, just a view on that first slide, is, based on the info that I've just showed you there over the last 2 to 3 years, we're in this incredibly volatile space. The market prices have gone from record lows in 2020 to record highs in 21 to even higher than record highs in 2022. And then they've dropped right off in 2023. And now we're in this precarious position in 2024, which we're going to unpack shortly. But I guess the third key takeaway for you here is when you look at the volatility levels in the cost of energy. So what this slide shows, if you look back at those previous 6 or 7 years, and if we take 2000 and 17 for an example. And if we look at the power bar for 2017, there was a 17% volatility in the wholesale cost of power. So typically electricity, back then it was about 50% of the overall electricity bill was the commodity. And what that graph shows is that in 2017, a manufacturing business, so you could have two businesses that both use 5 million units, that both require energy to be delivered on the same date, and that both make the same product, and that are even both working at the same profit margin. Now in 2017, there's 365 days in a year, but the difference between the best day and the worst day for buying energy in 2017 was 17%. So there could have been a 17% difference in the overall commodity cost, which back then was about 50% of the bill. Fast forward to 2021, and from an electricity perspective, that volatility was 405%. From a gas perspective, it was 650%. So what that meant was in 2021, two manufacturers, you could have been manufacturing windows, both making the same amount of units, both employing the same amount of people, both needing electricity to be delivered the following October or gas to be delivered the following October. But if you both went to market and asked for the prices on different days in 2021, you could have seen as much as a 400% difference in cost from a power perspective and a 650% difference in cost from a gas perspective. Now, the point I'm trying to make here is I'm not sure there's anything like this, like in this world. For most manufacturers, they're spending more on energy than they're making in profit at site level. Certainly for most manufacturers, it's one of the top 5 or 10 costs. You imagine if all of a sudden, and I've seen the amount of time this minimum wage increase is taking off people, by the way. You imagine if all of a sudden every single one of your staff members required a 379% pay increase in 2022, but your biggest competitors' staff members didn't. Now, if you're working at the same profit margin, that could potentially flatline your business. Like, I don't know what the fix is there. So I think the key thing here, and the key thing that we're going to unpack throughout today's session, is now is the time to start educating the rest of your business. And actually, now is the time to let them know that the world has changed. Like, the world of energy has changed. If you go back pre-2020, historically, energy was left to one person who maybe will have waited 6 to 12 months before renewal, signed a fixed price contract with the previous supplier, maybe even got a bit of a reduction. I think now that's substantially changed. We're seeing businesses win entire new competitive markets based on their energy rates. We're seeing businesses lose competitive market share based on energy rate, because almost the more they manufacture, the less profitable they become. So again, I think the key thing there is, although 2023, as I mentioned, the prices dropped off substantially, for power, there was still 150% difference in someone buying at the start and maybe fixing out, and someone buying at the end and maybe getting lucky in the market. So again, I think the key thing there is, when you're buying energy, you might think it's as simple as picking a day and going for it, but that is probably the most volatile part, because the difference in days, as you've seen in the last 3 years, could be anything from 100%, right the way up to 400% on a bad day.
It's a gamble, isn't it?
Yeah, absolutely, if you're doing it like that. So next slide, please, Alex. And I think before I look at some rates for today, I think that one of the next insights I wanted to unpack, and one of the big questions we're being asked at the minute is, so where are we now? What are prices going to do? Is now a good time to buy? Is now the best time to buy? Am I going to lose my job if I buy now? Am I going to lose my job if I don't buy now? And I say, look, I'm going to be completely honest. Like, nobody has the answer to what energy prices are going to be in 6 months' time. If anybody had that answer, I'll tell you this from an organization that trades 5 billion. If anybody had that answer, they'd be sat in the Bahamas waiting to make the next trade. No one has the absolute answer. So if I'm looking at buying energy today, I'm going to look at a few things. The first thing is, where are the prices as of today, right now? And we'll unpack those shortly. The second thing is, what are the things that are actually impacting the market? So in this new market cycle that Jordan spoke about, and a market cycle is a period typically of about 4 to 7 years. And in that period, there'll be a maximum price that the energy will reach, and there'll be a minimum price or a low that the energy will reach, the energy costs will reach. And the reason those parameters exist, by the way, is, the maximum price, which we assume in this cycle was August 22. no one could even buy energy at that time. So people stayed away and naturally the prices dropped off. Likewise, a low price, could be almost near where we're at now. And we're starting to see people starting to get active and starting to buy and starting to pile in. That then could cause prices to turn. But I think the key thing I'd be considering if I was a buyer today is, okay, where are we at right now? What is the downside potential? If I buy right now, or if I enter the market right now, what is the potential that the rate could have got better? And if it does get better, by how much? Truthfully, what am I potentially gaining by not going into market now? If we look at this market cycle and we understand that the worst case scenario, the peak of August was up at 450, realistically, by not buying now, I wouldn't necessarily say you're going to see 450 again, because that's probably not realistic. But you could argue it's reasonable to assume that there's an upside risk, maybe of the costs going up to £200 per megawatt, genuinely, if things don't work out in the market's favour. So for me, even if things carry on as they are, the first takeaway is they're not going to go that much lower. CFDs, which is the price being agreed to pay renewable generators far out into the future, are pretty much being agreed at this level, 4 or 5 years out. So that suggests that energy prices aren't going to drop much lower. Otherwise, renewable energy would largely become inefficient. So effectively, the question I'd be asking myself is, if I'm waiting, what for? There's a statement in trading which is, don't try to catch a falling knife, because ultimately at some point you're going to cut your hand open. And that becomes the problem when waiting for downward prices, because believe me, one thing I know right now is there's never been as many eyes on energy markets, certainly in your sector, because this fundamentally is one of the biggest things that impacts profitability. So I think finally what I wanted to leave you with today was just a view on where the actual market prices are. And I think, Alex, correct me if I'm wrong, is this as of close of play yesterday?
Yeah, absolutely correct.
So this is as of close of play yesterday. So first thing you'll know is you'll see at the bottom of this, there's summer 24, winter 24, summer 25, and so on and so forth. So typically, most users of energy will see their contracts start on either the 1st of April or the 1st of October. And the reason for that is the season of summer, energy is traded in seasons in the futures market. And the season of summer runs from the 1st of April, the season of winter runs from the 1st of October. So if I'm a manufacturer and I've got an October 2024 contract end date, or contract start date, should I say, right now, or as of close of play yesterday, the power price, which is the purple line, was trading at 71.51 pounds per megawatt. In pence per kilowatt, you just divide it by 10. So that is 7.15 pence per kilowatt. Interestingly, a few things, that's probably the lowest point it's been at any point in the last 3 years. So anyone that's actually had to buy in the last year or two will be looking at a cost reduction there. It doesn't factor in non-commodities. Again, we're trying to keep this around the commodity side of things, but non-commodities or the non-energy charges, that could be anything from 10 to 15p upwards. They all differ based on what you do as a business, when you use your energy, how you use your energy. I think the key takeaway for me on this slide, before I pass over to Alex, is if we were delivering this session a year ago, and we did deliver some of these sessions a year ago, you can go back and watch them, but years 3, 4, and 5, so the further out years, would have pretty much been where they're at now. Like, the market back then was in a state of backwardation, which meant that all of these short-term issues meant that years 1 and 2 of a 5-year contract were really expensive, but years 3, 4, and 5 weren't. What's happened now, based on everything I've been saying and how much in the short term has been going in the market's favour, those far out prices have pretty much stayed where they are. But the prices for energy to be delivered this year and next year, they've dropped right off, and they've almost all gathered up around this point that you see here now. So effectively what this means is, when I talk about 5-year prices, if I'm a manufacturer who's got a contract start date of October this year, October 24, energy, as I mentioned, is a genuine commodity, and that commodity is typically liquid for 5 years into the future. So you could be a manufacturer. In fact, a lot of Inenco clients are currently receiving energy that they bought 2020. So, 4 years prior, and they'll buy that energy in a contract that allows them to do something today. But regardless of what they do, they don't take delivery of that energy until way into the future, and don't start paying for it until way into the future as well. So I think that's the final thing I wanted to unpack. I know it's quite a complex market update, but I think it's warranted, because The market, certainly in my 13 years, hasn't done anything like this before. You know, we are in uncharted ground. No one can look back at last year and look at this year. No one can look back at the last 10 years and look at the next 10. So I think I wanted to just try and unpack as much of an insight as possible, give as many key takeaways as possible. We will take questions at the end, but I think for now, over to you, Alex.
Oh, cheers, Jordan. That was really thorough. So that was the market update, which, you know, there's been many key takeaways there from Jordan. What we want to do now is actually give you some practical guide off the back of that, of, you know, some of the routes to market, when you should buy, you know, what a contract length would look like. And finally, what we're going to touch on is applying a strategy to purchase it. So Jordan touched on it then. You know, this discussion is about the commodity piece. Obviously, there's other parts of your bill that, you know, depending on geography, where you're based, what meter type you have, you know, whether you've got a CCA in place or another scheme that can potentially reduce your non-commodities. But this piece focuses on the commodity side, which out of these four is typically the biggest weighted piece in terms of cost. So, I mean, Jordan, this is probably a question for you, but what are the routes to market, and how should people buy?
Yeah, so yeah, good point. I mean, firstly, just on this slide, this is quite important because there is no right or wrong way to buy energy. You know, there are many different routes into market, which is the first thing to understand when it comes to looking at energy. And what I wanted to show you here was a graph that effectively details how complex your approach to buying energy is and how much value you can expect, or what your unit rate may end up being. So, you know, the easiest thing to do if you've got an October 24 contract end date, the easiest thing, it's certainly not wise, is to do nothing. You know, your energy is not going to get cut off. You're going to roll onto a deemed contract and you're going to pay 5 or 6 times more than you should. Okay, but it's easy. It requires no resource.
Yeah.
The next best thing would be to just take a supplier's renewal offer. So whoever your incumbent supplier is, they give you an offer for another year or 5 years, and you just take it.
Would that typically be higher?
In what sense? What
a cost? Yeah.
Yeah. So it works in the same way as like car insurance, basically. So what most people might do then is the next step along, negotiate with that current supplier. So again, you're starting to step up in terms of the work you're putting out and what you're doing. But again, in terms of value, the overall supplier margin is only at most about 5% of the picture here. So from a profit perspective, it's more like 1%. So spending time in that area might not actually give you that much value. Okay. So moving on quite a notch in terms of complexity, what some people might do is run a number of tenders or run a tender, so a fixed price tender. So what they might say is, right, today on the 14th of March, I know that I need to get energy delivered in October. I know that I've got this contract that needs sorting. What I might do is ask a broker to run me a tender. So they'll go to a broker or a number of brokers. I think there's about 2,000 energy brokers in the UK. And they'll say to those brokers, can you get me a price from an energy supplier? What that broker will then do is contact a number of suppliers on that given day. So if that's the 14th of March at 11:23, they'll contact all of the suppliers they work with. They will ask for the price for energy. That will just be, you know, the biggest part of your bill. The commodity cost will then just be locked down because you'll just pay whatever the commodity is, you know, currently trading out on the 14th of March. The broker will then add their commission and they'll pass that back to you, the customer. So again, in terms of the complexity, it's starting to become more work involvement for you, the end user. But in terms of the value, there's not really that much value because the biggest part of your bill, as I touched on there, is the commodity cost. The thing that fundamentally determines the commodity cost is the day in which you go to market. So it's a bit like walking into a casino with 365 days on a roulette board. Picking one of them, you know, whether you're using a broker or going direct to the suppliers, it's a bit like picking one of those 365 days, chucking £1 million on it, or if it's 5 years, £5 million, and then thinking, oh, I hope that wasn't risky. So for me, I think even that becomes hedging your bets on one day. And again, the complexity's stepped up. People will often say, I've got a broker, I've got a number of brokers. You could have 10 brokers, and ultimately, if they're all going to market on the same day at the same time, they're all getting the same cost anyway. So you may as well just have one and save yourself the hassle of speaking to the other 9. And even then, the best thing to do potentially would be to run a direct tender. So for me, I think from a large or a mid to large energy user's perspective, wholesale procurement is what we wanted to talk about today. Yeah. Because for me, once you start using more than, say, a gig or two, more than 1 million units or two. There are a number of different things you can do in the market that mean you can actually enter a long-term contract, but not be forced to buy 5 years worth of energy on day one, for example. So the world just starts to look slightly different when we move into the world of wholesale energy. So I think that's what Alex is going to talk about now. And Alex, do you want to unpack portfolio and bespoke flex?
Sure.
So both would be what I consider wholesale energy. And I think before Alex does go into this, one of the key things, people often assume that because we talk wholesale energy, that means it's flex. That means that the rate must change every day. The rate will change every month. Oh, we can't do that. You know, realistically, wholesale energy doesn't mean that. You know, your strategy to wholesale could even be fixed. You just trade in the energy directly on the wholesale market, as opposed to going to a supplier and asking for a cost on a given day. So we'll unpack strategy shortly, but there's two different approaches to wholesale.
Yeah, and the two different approaches primarily just depend on how much you're using and sort of the level of involvement that you want in actually trading. So if we were talking right now in 2008, to access the wholesale market, an energy user would typically need to spend about £5 million. It's probably a fair number. Since then, there's something been created called portfolio procurement, or people might know as basket procurement. But this essentially offers small to mid-sized users an opportunity to group together their consumption and spend with other users into a basket to essentially access the wholesale market. If you entered into one of these baskets, you'd still have your own supply contract, your own trading strategy. You wouldn't be linked to anyone else. It's just a mechanism to get you into that market. It's a barrier that overcomes the spend. So this is typically for users that are using sort of 1.2 to 10 million units. It's quite a hands-off approach. Traders essentially control the basket and the strategies within it. And a couple of the benefits, you've got a big amount of spend in these baskets from company to company. They can barter with suppliers for specific non-commodity lines. They can help reduce supplier profit margin as well. You can imagine some companies out there, including us, one of our biggest baskets has quite a few hundred millions of pounds in it. So we can say, Mr. Supplier, if we're going to place this with you, we want a bit of a discount on our supplier profit margin. Then on the other side, you've got bespoke flex. So this is for the largest of energy users across the country. Anyone using above 10 million units. It's a very, in the name, a bespoke approach to trading. You have risk managers, traders, day in, day out, monitoring the market at every given point. You'd have monthly risk management sessions that look at actually, is this the right approach? What's going to happen in the market? Very, very bespoke, but for the largest of energy users. I think, a couple of people on this webinar might be applicable for the bespoke flex, but most of you might fit in the sort of portfolio approach to procurement. So, it's something that we've touched on throughout this session, and this slide is a reiteration of one that we've seen before. And timing is key. Jordan's touched on it, the roulette wheel. When should I actually go out to market? When should I put supply contracts in place? So in 2021, just an example, just to reiterate this point that how key it is, a buyer spending £1 million on energy could have purchased, let's say, right at the start of 2021, and the same business, if they went to market 365 days later, would have been paying £6.5 million more for that energy.
So that's just that volatility percentage, but we wanted to give it you as a visual. So a user that was spending £1 million, the same amount of units, but hit at the top of that volatility. And again, these are two extremes. We're talking someone paying the lowest available would have got it for 1 million in 22, let's say. Someone paying the highest available for the same amount of units will have been paying 3.79 million more for the same thing delivered on the same day. And again, I know they're extremes, but the vast majority of people will be in between that somewhere with these wild, and again, the parameters are that large that even though they are extremes, the gap in the middle, there'll still be 50, 100% swings all over the place.
Yes, no, exactly. So it is just showing that extremity, but the importance placed on timing is key. And I think part of how, some of you out there will be going, well, how do I time it right? How should I do this? Well, there's Inenco has market reports out there where you can get daily updates. But one of the key things that timing will feed into is the strategy that you choose to move forward with, that takes the hassle away from time, that takes the impotence away from you, a buyer, making that call to a broker. The right strategy, which will come on later, actually removes the pressure of timing. John, have you got anything else to add on that before we move on?
No, I think that my key takeaway from all of this, we're talking about volatility a lot here. And I think the reason for that is, regardless, I guess you could say the better energy prices are at the minute, the more we're expecting this volatility to potentially still be apparent as well moving forward. That's, I guess, one of the key messages in 2024. I would be very, very shocked if we went back to the very, very stable world. Because if you look at geopolitically a lot now, with the gas storage facilities maybe a little bit different to where they were a few months ago, I think there's the potential that volatility at least could come back.
Yeah, it boils down to that downside reward again versus that upside risk, doesn't it?
Yeah.
So the next sort of key takeaway is, how long should you contract for? And I want to make a very distinct difference between contract and buy for, because I think they're very two different things. Jordan touched on it before about the current market prices. Whilst backwardation isn't as clear as it was, the further out we look, the cheaper prices get. There is still, that summer 28, some of you might saw that season of energy is currently trading at 5.2 pence a kilowatt, which, all this discussion about going back to old world norms, that given season isn't that far away, is it? 0.2 pence away from the old world norm. So having the opportunity to buy and buying are two different things. So the phrase at Inenco, you've got to be in it to win it. A lot of our success stories, some of them that I'll come on to in a minute, have come from organizations that have been in long-term supply contracts, that have given Inenco the opportunity, or the traders the opportunity, to buy long-term if they need to. So we would always recommend, for anyone that fits within those wholesale procurement criteria of the 1 gig, to 10 gig and 10 gig above, having a long-term supply contract in place. Yep. We don't mean buy everything now. That's just the same as what Jordan was saying about the roulette, but just on a much larger scale. That'd be 1,900 days you'd be buying for. That's not what we're suggesting, but just have the option to buy if needed.
Yeah, I think the key thing you want to avoid when putting in an energy supply contract and thinking about the length of that contract is avoiding becoming a taker of market prices. Imagine a world where you've got a diesel car and you're about to run out of diesel, and the only petrol stations around you are charging £4 a litre for diesel. Regardless of what you think about it, you're going to have to buy some. Otherwise, you're breaking down and the cost is going to be much more. With energy, what we're trying to avoid or recommend avoiding is a similar situation to that, whereby you do nothing until a point arrives where you're 2 or 3 months away from going out of contract, and then you have to do something, but there's no time to look elsewhere. There's no. So again, that then puts you in the position of being a taker of market prices. And one thing we know is, when you look at the biggest losers over the last 3 or 4 years, those were the ones financially. Those were the ones that unfortunately were left potentially having to buy at peak a couple of months away from contract start date, because then the suppliers didn't necessarily have an appetite for the business. The insurers didn't necessarily have an appetite for the business, and they were just reacting a little bit late. I think the key thing is, there's already businesses that will be operating within 3-5 year deals, waiting to take volume, waiting to hedge. And if you're not in that position where you've got a contract, let's say you see a price that you like the look of and you want to run a flex tender, it might take 4 to 6 weeks for that contract to come back. So by that point, the price has gone a little bit.
I really like that analogy, because we've all been there driving down the motorway, £2.50 a litre, and when we wish we'd filled up at home on that £1.39. Yeah. But yeah,
there's really a comment about someone hearing, so maybe we'll just speak up a little bit, Alex. But yeah, I've just noticed that.
Okay,
carry on.
So now you understand about the timing, the contract length. It's now time in a wholesale approach to apply a strategy. Now there's many different strategies, combination of strategies, etc. We could have a whole session on strategy, but what we're going to do is, this wasn't a focus on strategy. It was about markets and applying some practical guides to what you can take away. But one thing we're going to give you is an example of a strategy, a popular strategy at Inenco and at other consultancies, but this is the capped strategy.
And I actually think that's a key point. It isn't an Inenco sales pitch this. We'll talk about how we pioneered the cap strategy, which we did, but this is something that other consultants, other people will do themselves. We just wanted to give you a visual as to how a strategy within wholesale procurement could work.
Yeah, exactly. So we're going to give two examples, and one of them is how a capped strategy works in a defensive position in a rising market, which could be very apt at the moment. Prices are quite low, something might turn. So this is an example of a rising market. So the cap, keeping it brief, keeping it simple, is typically set at 5% above the market rate. The reason for that is to allow for intraday movement. And what the cap is a buying mechanism, a trading trigger. So this essentially alerts our trading team when to buy. So in this example here, what basically happens is that a cap was set late into 2020. That cap was hit. Our trading team forced a trade and locked out. And as the market continued to rise and rise and rise to peak, the price that the cap was hit at stays the same. So in this instance, where the cap was hit.
So just to unpack what the cap even is and when it goes in and day one things.
Yeah. So the cap is that 5% above the margin. It's a trading trigger. What your caps are essentially is on day one of trading, when you come to an Inenco or another consultancy, they will take an observation of the market, look at all the seasons that you're going to be purchasing, and put those caps in at 5% above the market. The reason for the 5% again is just to allow for intraday movement. Typically the market moves a couple of percent each day on average, so we don't want to alert a cap by accident. So in this example here, just again, the market, the cap was set above the market at 5%. The cap was hit very late into 2020. In this instance, I think it's about 5.5p that the cap was hit. That means that the traders bought at 5.5p. Now this was for winter 22, the season of energy that went to the highest. And that user of energy there was locked out at 5.5p whilst all this craziness was still going on and the prices of energy was rising for that given season. So they were completely protected. In terms of what that looked like from a numbers perspective, this was a manufacturer using 5.5 million units. They were locked out, in fact, at 5.1 pence per kilowatt hour. Now, against market peak, I always take market peaks with a pinch of salt. They mitigated a cost increase of 4.5 million. Even against market average for that year, just achieving an average, it still mitigated £1 million. So that's how it works in a defensive manner, but the cap also can work in a falling market. And I'll cover that off. Well, Jordan's going to cover that off now.
So I think, just to reiterate, so with this, what we're trying to show you is an approach to the market. The visual or how a capped approach would work is typically a customer would have a contract end date that might be anything from 6 months all the way out to 2 years in advance of starting. We'll look at the price on day one of trading. We'll get customers into that supply contract nice and early, typically for 5 years. We'll look at the price on day one of trading. We'll set a cap at 5% above that cost, because the idea is we don't want to leave you completely exposed to the market, but likewise, we don't necessarily want to buy everything on that day one. So effectively what we'll do is we'll put a cap in place. Now, this was a customer who joined in November 22. And again, what we want to do is show you an example as to how a cap could work in a falling market. So this customer historically had always bought in November. for delivery the following April. So they had always bought in around about November, December time for a contract that needed to start the following April. And what they would have typically done is gone to their supplier, gone to a number of suppliers and asked for a price or a number of prices and picked one. Effectively, we said to them this time around, look, the market's in a weird position. It could rise and carry on rising, so we'll put a cap in place. However, it could also potentially fall. So rather than fixing out everything on day one, let's put a cap in place. And if the market shoots up straight away, we'll lock out and we'll be able to purchase. If, however, the market falls, then we're potentially in a great position because we'll track the market down, right up until a point where it looks like the market's going to breach the cap, and then we'll make that trade. And again, in this instance, for this customer, financially, so at the point in which they put their caps in place, I think the market was at around £242 per megawatt. The peak during that period went up to £308 per megawatt. The average was 202. But by putting a cap in place, putting a contract in place, and then just tracking the commodity cost down but not up until a point when they needed to then buy it, they mitigated in excess of £1 million. Now, that was a substantial result because that was for a period of 4 months. Now, don't get me wrong, the market did them a favor there. But even in the flip reverse situation where, what we expected, like the market shot up, then actually they would still have been benefited. They'd have still have benefited from that cap because that's when they would have been protected and they'd have had the cover that Alex showed you in the instance of a rising market. So the reason we wanted to pick this strategy, and again, there isn't any strategy that fits all. No two businesses are ever the same. But this is the sort of have your cake and eat it, because it allows businesses to set a budget on day one, to have some kind of visibility of what the worst case scenario over the next 5 years is going to look like. But it also then allows them to chase the market to a decent entry point. So yeah, we wanted to give 2 examples to try and bring it to light there.
No, yeah, that was brilliant. So I guess, we've covered quite a lot today, and I know it's been quite a whistle-stop tour of Inenco, of the market, of future trends, of some practical guides. So I think, Jordan, do you want to summarize some top takeaways for today?
Sure. Don't delay contracting. I've talked about this often, but and Alex has, not just in the last 45 minutes, but what we saw in August 2022, when the market's in the condition it's in, which is incredibly responsive to bad news, what we saw in August 22 was even the businesses that wanted to react, that then wanted to go into contract, there was this massive lag or this massive delay from suppliers because that many businesses hadn't yet got into contract this close to delivery, that there was then this huge backlog of, certain suppliers even refused to take on new business so they could sort out everything that they had. We saw situations where, for instance, let's say the commodity cost jumps up by 100%. The insurance that the supplier then needs to take out materially changes, because they need to get insured to go and make a trade for double the value, which over 5 years could be 5 times the cost maybe, which that's then seeing businesses need credit checking for situations they would never have needed before. So I think the first thing is don't delay the contracting side of things. You can always put a contract in place, like Alex said, that doesn't see you hedging everything on day one, and at least you're then in a position to do something. Secondly, I think from a contracting perspective, take a long-term view of the market. You've got to be in it to win it. You could do a 1-year contract or 5 1-year contracts, and ultimately you're going to be at the hands of the market 5 separate times, effectively. And not only that, you're not going to get much from it in terms of financial benefit, because the suppliers aren't making that much in the first place when you consider the bigger picture. I know a lot of the upstream generators are, and a lot of the press around domestic energy says otherwise, but business suppliers are going under at a rate of knots. They're not making the money people think. And I think the final point for me, before handing back to you, Alex, and maybe some questions, is the strategy needs to suit the business needs. Like, there is no off-the-shelf strategy now. It's no longer the days of buying energy the same way you'd buy car insurance. I think for me, going against the status quo, going against the norm. Now, a lot of businesses that I'm speaking to, they've got owners, they've got shareholders, they've got VCs even. They've got people that they're that they're answering to. And I just don't think the safe option even anymore is doing what we've always done. I think now the idea is to actually look at this, look at how big this is, look at what this has the potential to impact. You know, an energy cost increase of £1 million for a manufacturer running at 5% profit margin is £20 million worth of sales they need to find that year just to break even. Like, how interested would the CEO be if you offered him £20 million worth of sales or her overnight? Like, very interested would be my guess. So I think that's the thing here. That's the kind of importance this needs, which would probably be my final takeaway before handing back over to you, Alex, or for some questions.
Yeah, no, I think that wraps it up really well. And I think just on that last one, you know, a lot of people relate it back to domestic energy and they think, oh, you know, we just can't do anything. But you know, you're so wrong in that aspect that it's so different, but there's just nothing like it in terms of business energy.
Yeah.
Paul, have we got any questions? Over to you.
We do. Thank you very much. A couple of them here. You've touched on a couple of them, but the inevitable one here is how far do you think prices could fall?
Yeah, it's the $1 million question. Yeah, no, it is. It's the $1 million question, or the X pounds per megawatt question, so to say. But I think that the reality of the situation, going back to that earlier slide I presented about upside risk and downside potential, I think in the past, when buying energy, it used to be around sort of picking a number as a target and then aiming for that number. So maybe we wanted to see 10 pence per kilowatt, or maybe, you know, fully delivered, or maybe we wanted to see a cost reduction. Whereas now I don't think it's about that, because I think what is even a good number? Like, people that have seen holding off, the prices that they've seen, they're like, oh, well, this may carry on. You know, I wanted 7 pence and now it's dropped below. Maybe now I want 6.5. So I think for me, the question becomes, if you don't buy energy today, and it goes wrong and the prices shoot up 50 to 100%, what's your answer in 6 months' time with the board? Like, what did you see that warranted you holding off at mid-March when prices were at the lowest point they'd been in 3.5 years? I mean, fair enough, there might be people that do it, there might be people that do it and it comes off. But again, even if that is your approach, now would be the time to just document that stuff and to just write it all down, because no one knows how low they're going to go.
Yeah.
But what we do know is that we're not really judged in the present moment either. We're judged in the future when it comes to buying energy on decisions that we made probably 2 or 3 years ago. So for me, I'd be saying, I don't know how low they're going to go, but I'm going to be painting a picture around what's the risk of me not buying? What's the potential? You know, if I do buy now and prices drop, is it going to drop by like 1%? Because it's not really that big anyway. But if I don't buy now and prices rise by 100% commodity, well, that's quite big. You know, the juice isn't really worth the squeeze, for want of a better phrase. It'd be like betting on a horse that's 100 to 1 odds on, and it's not necessarily gonna stack up. So yeah, that would be my answer there. There isn't really a number.
Yeah.
And another one here. I mean, again, it touched on your takeaways, but perhaps you might expand on it a little bit. But how would you advise somebody who's currently looking to buy in terms of timing?
Sooner rather than later. Again, Alex, you might have something to add, but for me, just following on from that last school of thought, if you will, if you're not engaging suppliers or consultants right now, then why not? Like, what is the reason? You know, it's if you've got your consultant in place and you've got a view on the supplier you want, then go and get that contract put in place. You don't necessarily have to buy right now. You can start that process. You can start the onboarding. Like I said, the key thing is, all I know in this market cycle, and given these rates of volatility, is the minute prices get to a real high point, no one's going to want to touch them. The minute they get to a low point and people start buying, the momentum's just going to be massive. So for me, from a timing perspective, again, I just think now is the time to either be taking action or to be having your eye on the ball every day, or at least to have someone else who's got their eye on the ball every day for you.
Yeah, no, I'd agree. And I think one more point to touch on that is, if you remember that market liquidity graph that we showed you, you know, summer 28, one of the seasons quite far out, that's at 5.19p. You know, can that go any lower? That'd be old world norms, and we've still got everything geopolitically still going on. So, you know, backing up that, can it go lower point? Some of these seasons, maybe not. But I think, just to reiterate on Jordan's point, absolutely now is the time to at least start talking to suppliers on getting onboarded, getting in a position to actually trade.
And a lot of the businesses in 22 that were the real winners, that were paying a 10th, a 20th lower than everyone else, they didn't have a magic wand, which is what they would have needed if they were buying that in 22. They'd actually just bought it 3 or 4 years prior. They were in strategies a long time before all of the chaos kicked off, if that makes sense.
Yeah, that
and I think now's one of them opportunities potentially, by the way, given the market.
Okay. On a slightly different tack, what might be the biggest internal challenges people will face when they're trying to achieve efficient energy procurement?
Yeah, that's a good question. So for me, this is interesting. So 13 years selling energy, for want of a better phrase. What's been blindingly obvious to me in the last 2 years are the people that are involved in the energy making decisions now. I touched earlier about a manufacturer that might be running at 5% profit, all of a sudden seeing £1 million cost increase and what the impact would be. But genuinely now, one of the challenges will be for manufacturers, but for all businesses, but maybe manufacturers have it magnified. CEOs are going to be interested, FDs are going to be interested, CFOs are, the whole board in some instances is now going to be interested around this as an issue. And I think the challenge is going to be, A, they've never really been interested before, so you're having to educate them. B, the markets were totally different. So if I'm buying energy right now and my CEO hasn't been involved before, and all of a sudden it's looking at a cost increase because they last bought 5 years ago, it's like an education piece. So I think the big challenge for me, or if I'm an end user and what I'm thinking the big challenge or even the big plan would be, I would want people on the journey early. I'd want to be educating people. I'd want to be educating my peers as to, this is what we're doing. This is what we're about to do. Nothing we do now will be even able to be judged as good or bad, because we can't judge it against the past, because the past is irrelevant. Do we go off last year, which was prices we'd never seen before, or do we go off 4 years prior, which is potentially prices we're not going to see again? So for me, it's more about this kind of webinar, this kind of session. It's more about that education piece and looping in as many of these stakeholders who genuinely, not for any bad reason, but they just won't necessarily have needed to be involved in this before. And now they're needing to be involved, educate them right, get them on board from the off.
Yeah, just to build on that, I think a point that you've touched on already is that profit margin perspective. I think when you talk to the finance guys and get them involved and put it in a language that they understand,
Yeah, it's a good point. Put a financial lens on everything as well. If you're trying to get your business to do something or to change or to get behind you because you want to do something, again, you might be the person in your business that's looking at this day in, day out. They might not be. So even internally, you might have to do as much selling as maybe I would to get the business to go for something. So again, for me, I'd say the tip is to just put a financial lens on everything, because for manufacturers, energy costs, when volatility is like this, it is going to material impact business like not much else. I always use that staff analogy. Most manufacturers on one side, they might have 60 or 70 staff. If all of a sudden you needed to pay all of them double, that's causing real issues, maybe even a month or two after. I don't know how long that you're able to carry on. Something has to change. And I think this is a similar thing, whereas I think the thing that needs to change maybe is just people's approaches and the education side of it.
Yeah.
Okay. Right. Thank you very much. That's all we have time for. To anybody who has any additional questions, we will hand them on to Inenco and they can answer them for you offline. But in the meantime, it just remains for me to say thank you to Jordan and to Alex, and thank you to all of you for joining us. Thank you very much.
Thank you.
Thanks.